Hi there. Today we're talking about seed capital. What is it? And some examples. And how important is it? Well, that last question is the easiest. Seed capital is very, very, very important. Extremely important. Now, essentially, definition, well, if you see a company trading on a stock exchange, its shares, fully paid ordinary shares normally, so no more to pay, and they're just fully paid ordinary shares. That's not seed capital. That is a listed stock trading in the secondary market. When they do a placement, that's a primary issue, placement of new shares that then start trading in the secondary market unless they're escrowed for a while. However, some of the shares trading on a stock market would have been issued prior to the float of the company on the stock market, before the initial public offering or the compliance listing. And that's what we call seed capital, where people come and bought shares in seed, or it could be founder capital as well, where the initial company is set up and founders chuck in a small amount of money for shares at a cent or a fraction of a cent, often in order to incorporate the company and get it all going and arrange the relative stakes of the different directors and employees in the company. So before a company is listed, you have founder capital in the early days, then you have seed capital, and you may have some employee share schemes as well. And of course, some companies just stay private or unlisted, publicly unlisted companies, and they don't trade on an exchange. So you simply have founder capital and seed capital. Now, you may have heard of Series A, B, C, and D. That's sort of nomenclature from the west coast of America, where they have a system of seed capital, then A, B, C, and D, and it's sort of grown up over the last 20 odd years about how it's done at different valuations, so on and so forth, and then at some point the company either is bought out or it lists on the stock exchange and or it falls over, which can happen to especially pre-revenue companies, pre-revenue, pre-profit, so either pre-cash flow or pre-profit. So that's where seed capital is very important. Seed capital funds a company prior to its float and prior to its profit. Because if it's profitable, it doesn't necessarily have to, but obviously profitable companies still can issue more shares to raise capital, but it's not a matter of life and death if you're making a profit. So seed capital is very important, but obviously it's far less available than shares trading on a listed stock exchange. Technically, anyone can buy those shares. If they have a broker and a broking account and some money, they can buy those shares, or they can end up with an interest through a managed fund. Shares in a listed company are freely available, trading on a stock exchange, and the stock exchange ticker will give you the price, gives you price discovery. Seed capital is not listed by definition, so you don't have that price discovery. You don't have it trading on an exchange, so you can't see what the price is. And it's basically what the seller wants for the stock, and that can be high and low. And a lot of companies are using seed capital to basically finance themselves and go to listing much later, only once they're ready and they've got a nice profit and everything looks fine and dandy in the business, rather than trying to unwrap the business and build a business more during the listed life of the company. They try to do it more undercover now using seed capital. And there are rules about who can purchase seed capital, or how many shares or how many shareholders companies can issue seed capital shares to in a 12-month period. In Australia, for example, without a prospectus, right? If those shareholders are not sophisticated, not 708 compliant, Section 708 of the Corporations Act. So, and that's only a 2012 rule, any 12 months rolling, without a prospectus, who are non-sophisticated, non-Section 708. So there are rules around it that limit the application of companies using seed capital issues to finance themselves. But even if a company wants to and has got plenty of room to issue seed capital, you've then got to find the buyers, and that's more limited, because whereas there's schemes to provide shares, seed capital shares, to employees as part of their benefit arrangement, under certain schemes, employee share purchase schemes, which have certain tax provisions for people under 10% in Australia, for example. The reality is you've got to go to specific brokers or specific investment houses, specific banks to find buyers for those shares, because it's a much limited pool, because there's a risk that the company doesn't list and the buyer of the shares, of the seed capital shares, can't sell their shares. So it drastically limits the number of interested investors and you have to go to a seed capital specialist to basically help you sell the shares, unless you're selling the shares to what they call the 3 Fs: family, friends, and fools. So family of yours, friends of yours, or fools who are so risk favorable that they're happy to get in at an early stage, even though the risk is high that something happens and the company can't float and they don't get liquidity in their shares. So that ultimately is a lot of the problem. You have to find a broker or corporate consultant or banker who can find enough investors to sell enough seed capital to make it worthwhile for the company. And slightly, well, basically the same overseas. There's a slight variation for America in that, as I mentioned, they use Series A, B, and C, especially for tech companies on the West Coast. And there's certain venture capital funds who just sort of sit there and they partake in A, B, C, and D, depending on if they like the project and or the management and track record and technology, so on and so forth. So it's a bit more formalized there, but it's more open slather elsewhere. So in Australia, for example, in the mining industry, you'll often see companies issue shares at 5 cents, 10 cents, and then they'll do a 20-cent float on the Australian Stock Exchange. And then they obviously go up or down from there. But that's how it happens in Australia. A lot of those floats happen out of Perth, obviously, but also Melbourne, Sydney, Brisbane, and Adelaide to a lesser extent. And of course, that happens, they apply the same rules basically for pre-revenue companies in other sectors as well. So biotechnology, information technology, so on and so forth. That's how it works. But seed capital is very important because it funds the company pre-profit or even pre-revenue. It funds a company pre-listing, obviously, because that's what it is. A seed capital is shares in a unlisted company. But also, it's the money that is provided to these projects that really need to get going with new technology. So taking the idea, the concept, or the intellectual property, or maybe even just prior to the intellectual property, so still paying for some of the R&D, to commercialization. And that's historically been the valley of death in Australia, America, Canada, Britain, well, all countries basically, because you've got to take ideas through different stages, often done at universities, finance through there, and then finance from there, from the intellectual property attainment, so getting the patent, finally, to commercialization, so turning it into a revenue producing, then profit producing business. That's a long way. It has been called the Valley of Death in the past because so many ideas or companies die along the way. And it's an issue that's come up in America, Canada, and Australia. And it's a gap that the globe needs to close if you want cures for cancer and all other diseases, Alzheimer's, Parkinson's. If you want to sort out climate technology, do all of that. If you want to find new cures for other diseases, if you want to find new deposits of oil or metals or anything else that is R&D intensive, you need to find the money for these projects, and a lot of that will come from seed capital. And you often hear about the successes, but there are plenty of losses and failures along the way. But it's absolutely necessary if you want to build a knowledge economy and have higher paying jobs that you have a way of funding that process from idea to commercialization. And that's a very long way. Can often take decades, multiple decades, not just multiple years, but multiple decades. But it's absolutely necessary to provide the new products that we all want. That's seed capital. If you've got any questions, email me at andrew@keops.au. That's andrew@keops.au. Thanks.